And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Can't believe it's Friday already, but here we are once again. Luke Smith, good afternoon.
Good afternoon. It's like I might as well open an office in here, I think.
Oh, I think you should, absolutely. There'll be plenty of passing trade, people dropping in at all hours of the day and night asking for some financial advice. We could absolutely do that. That wouldn't be any trouble at all. There's been massive breaking news yesterday. The Albanese Labor government has had to perform what some have described as a backflip in relation to some of its tax changes from the federal budget recently announced.
Yeah.
Now, there were a number of changes, and they included changes to the capital gains tax, where the discount was changed from 50% and the old cost base indexation was reinstated. There was the elimination altogether of negative gearing, which is a whole other can of worms. And there was the decision to impose a minimum 30% tax on a range of trusts and other instruments. And this, of course, prompted a lot of criticism, particularly when it came to testamentary trusts. Here's the backflip. There's now an exemption for the testamentary trusts.
Great backflip. At last, some common sense has prevailed. I think the whole trust scenario has been far more important than people have realised in relation to the implications of negative gearing and some other parts of the suggested changes. And I think from a testamentary perspective, this is just common sense prevailing for your average person, because after all, isn't he there to represent the average person? And the average person has a family. The average person wants to do everything they can in their working life to assist the next generation. And to put forward what he put forward in relation to testamentary vehicles, I think is nothing short of despicable. And common sense has prevailed, and he's probably realised that everybody hates him, and he's backflipped on it, and great, there's a win for the people.
Okay, so there were also some changes made to the position for capital gains tax, but that's not our topic today. Maybe we'll look at that on another occasion. But in particular, testamentary trusts, let's take a closer look at those. What exactly are they? How do they work, and why are they important?
Yeah, so a testamentary trust is a vehicle that's created through a well-written will. So, as the name says, it's testamentary. It comes to life when you've died. So where you've gone and got good estate planning advice from a solicitor, the solicitor would ask questions like, hey, Leon, if you died, would you like to protect the assets and anything that you want to pass to the next generation to limit the potential loss from a range of different parties? And you'd say, yeah, that sounds great, as all parents do. And a testamentary trust is a wonderful vehicle because you can leave assets to that structure when you die, and it provides an element of asset protection. Now, we have to separate here. I've died. I've left some money to my daughter. My daughter has a husband, and my daughter has inherited X from me, and then they decide to separate. And said husband goes, well, I'll have half of that. A lot of parents don't like that, or the potential risk of that. And one way to try and mitigate or limit that risk is to use a testamentary trust vehicle where you might say, I'll leave what I was going to give my daughter, I'll leave it in this vehicle for her benefit. So the first key benefit of a testamentary vehicle is the potential use of that structure for asset protection purposes. It's a lot harder to lose what you don't own or have limited or no control over. Now, this is a relatively complicated area where you really do need specific advice in relation to the structure, but also then the control of that structure. The second part, and one of the key benefits of a testamentary vehicle, is that they allow the distribution of income to beneficiaries, one being, let's say, daughter, but also then potentially daughter's children. So I've got a job and I work in the government and I earn $150,000 as a level 6 whatever in the department of whatever. And I inherit my parents' house and $1 million from their superannuation. Okay, just making up numbers. If your parents were to leave you those assets, anything earned from an income perspective would be added to the income that you receive doing your job. So you have a starting position of $150,000 of wages. And if we use an example, we have $1 million invested that earns 50 grand, and we have rent from a house that earns another 50 grand. So the individual would have taxable income of $250,000, which isn't great. However, if the $1 million is left to the testamentary trust along with the house, the daughter in this example could go, oh, I have 2 children. I could give $50,000 of the earnings to one and $50,000 of the earnings to the other. And the benefit of that is that a testamentary trust is one of the few, if only, vehicle that allows the distribution of income from a trust structure to a minor whilst they benefit from adult marginal tax rates. So when you distribute income out of a normal family trust, there's a threshold that you can pass income to a minor, and then you are significantly taxed after that threshold. With a testamentary trust, you have the ability to take advantage of a full marginal tax rate. Which
means you get full access to the tax-free threshold.
Exactly right, and the sliding scale all the way up to a 3-year-old. So it's a wonderfully flexible vehicle that a lot of people use to be able to control the distribution or transfer of assets, protect them from a capital perspective, also then potentially use them as a blended family tool. So you say you've got a blended family and you might say, well, I'm going to leave these assets to these kids on this side and these assets to these kids on this side. So from a generational perspective, they're very, very handy. But one of the key benefits that everybody loves is that you could have income from the assets in the trust passed to minor children, and you're not absorbing them like you would if you'd been the primary beneficiary of your parents' estate, because anything that's earned is then added to your marginal tax rate. So asset protection and the ability to distribute income to tax-effective beneficiaries is really the key attributes of that vehicle. And with what they'd proposed, they were going to say that there was a flat 30% tax on anything coming out of those trusts, like they have with discretionary family trusts. And from a comparison or from a perspective of, well, what do I need to earn to be at 30%? A lot of people don't realise you need taxable income in your own name of $200,000 before you're at an effective tax rate of 30%. That's a lot of money to have in your own name. By comparison, anything in a family trust to then be taxed at 30% is a significant disincentive to use that type of vehicle, which is why now, from a planning perspective, if all of these changes get up, people will be looking at the use of that vehicle going forwards, because you would need a significant amount of capital in those vehicles to warrant it being tax effective in the future should all the proposals get through. So for this to be removed is a wonderful decision and a wonderful outcome for not only mums and dads, but also the beneficiaries of that generational transfer of wealth.
The idea of a testamentary trust might seem a little bit confusing and complicated to a lot of people, but of course, as you indicated, you really do need to consult the experts to make sure it's set up effectively and in a way that achieves what your goals are. So that means, of course, consulting a good family estate planning lawyer, right?
Yeah, look, exactly right. Because control is one of the key attributes, and I was away on last weekend with a group of lads, and one of the lawyers there went, oh, well, if I was going to hack into that, I'd look for this, I'd look for that, I'd look for this, and he kept reverting back to who controls it and what's been written into the deed of the trust. So these can be very, very specific. They can be very broad. And again, obviously, there's different ways to have a go at breaking them down, because if you're on the attacking side, you'd want to have a clear indication of what you were trying to get to. And from what I can gather, again, from the conversations I've had with solicitors is, well, who controls it? What was the purpose of it? What does the deed say? And it's a wonderful, wonderful vehicle. And I have people come in all the time and have never, ever heard of it. And when I say something like, do you want to try and protect assets for the next generation? 99.9% of the time, people sit in front of me go, for sure. how come no one's explained this to me? So I guess it also then segues us into don't dismiss the importance of a well-written will. Because if you get something from the post office, I can assure you there'll be nothing in there in relation to the use of these vehicles, which when you look at the cost of getting this done well against the cost and the tax implications and the potential loss that's on the other end of that transaction, I'd pay to have good advice from a specific professional any day of the week.
Luke Smith from Envision Financial is with me today, and we're talking about testamentary discretionary trusts because, well, they're in the news at the moment, and the government has decided to back away from its planned changes to the arrangements, the tax arrangements on those trusts. But, of course, some of the other measures in the budget are still likely to proceed. We'll deal with those one by one as they come up for discussion in coming weeks. We'll be back with more in just a moment. Luke Smith from Envision Financial is with me in the studio today, and we've been talking about testamentary trusts. What are they? How do they work? And are they the smartest thing you've never heard of? I tell you what, I reckon they probably are.
Do you know what? I reckon 99% of the people that walk in my office look at me and go, who do you trust? What?
What? Yeah.
Huh?
So we've got to the point where it's time to go through some of the key things for people to remember about setting up a discretionary testamentary trust.
Yeah, so look, the first thing is this is not something that you will ever see. A lot of people say to me, well, what does it cost and what have I got to keep doing to keep it going? And well, it doesn't matter because you're never going to see it.
It only comes into effect when you're dead. That's
correct.
right.
So it's not a cost you're going to incur.
No.
But you need to ensure that it is written into your will because it's your will that then has the power to bring it to life.
So I suppose up front you need to spend a bit of money on getting good legal advice to write your will.
Yeah,
and that's it.
And that's right. And these things are not, they should not be ridiculously expensive. If you need the name of somebody that can do it very cost effectively, reach out to my office. More than happy to put anybody in touch with the people that we use because we know they do a good job. That's not to say you can't go to your existing provider from a legal standpoint and they'll do just as good a job or if not better. That's do whatever suits you. But if you don't know where to go and want some direction, more than happy for people to reach out. We can put you in touch with someone. So you've got to write it in the will. You'll never see it. It comes to life after your death. The deed is then created, and what happens is you then stroll down to the bank and you'd say, hey, look, this entity's been created. Can I get a bank account for it, please? Yes. And then you would start transferring assets into that vehicle per the directions that are in the will. So we've got to start with a really well-written will, and then that gives you the capacity for the next generation to bring this document to life.
Okay, so to be clear, that would be the executor of the will gets to organise all of these things.
Correct, yeah. Great, fun job.
Yes.
Yeah, definitely put your hand up for that in the family. Remember that your super is not controlled by your will. So if you have binding death nominations in the super fund, you need to get the super out to the estate for it to then fall under the will. So ensure that if you're looking at your will, you're then considering your superannuation implications and the binding death nomination that you can use inside of super to have it pass out on your death to then fall under the umbrella that's controlled by the will. You then need to keep in mind that you have the ability to pass income out to beneficiaries. You cannot put money back in. So with a family trust, you can pull money out, put money back in. You pull money out of a testamentary trust, you cannot put it back in. Okay? So be mindful that just because you hear the word trust in the name, it operates like all the others. No, not always. You can then protect assets from a generational perspective, and as a parent, everybody worries about that. So that's one of the key benefits of this vehicle. It will need to do a tax return, just like any entity that owns assets, whether it's a super fund, a family trust, a testamentary trust. The trust will do a tax return every year, and the assets can sit in there for as long as you need. Another big question I get all the time is, well, what if they just want to pull the money out and use it? They can do that too. So don't think for a second that it's locked in there. There's nothing like that. If your kids turn around and go, all right, well, we've got half this house each, and my brother and I go, well, we'll sell the house, money's in the trust, we'll just rip it out and we'll go to Coachella. If you want to do that, happy days. There's nothing saying that the assets must stay in there. Now, I caveat that by saying you can put things in the trust deed to control the use of the money, whether it's income, capital, and try and sort of pull some strings from the grave. There's the potential for that to occur. But it's really just a case of making sure that you have the right documentation, it achieves the specific outcome that you're after, get some good advice in relation to its creation and its use, and take advantage of the vehicle flexibilities that this entity sort of provides everybody.
Fantastic.
And understand it.
So, Luke, where can people get more information?
Yeah, so 62604749. We've got envisionfinancial.com.au on the internet. We've got Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where you can subscribe to the channel and get a whole back catalogue of our shows. And we've got Smart Money Strategy, your ultimate guide to financial planning, where we've got an entire chapter on estate planning, and this is one of the most read parts of the book.
Sensational. Available in all good and bad bookstores. Luke, thank you very much.
See you next week.
Luke Smith from Envision Financial, back with us again at the same time next Friday afternoon, right here on 2CC.